Hello there, Hector Deville here. Welcome to a whole new, tutorial set of videos, to a whole new module where we're going to be looking into trading Forex if you have a full-time job, okay? If you have, let's say, only 20 minutes a day to trade Forex, well, because you have, a day job, or because you have family commitments, or because you just don't want to be sitting at your trading station all day long, whatever the reason may be. Well, I'm going to show you different techniques over the following videos, different strategies to trade Forex from a part-time basis. All right, again, you will see again with the following strategies how 20 minutes it's going to be enough to keep up with your Forex charts, to keep up with your trades, and how you can actually get involved with the Forex market, how you can profitably trade Forex without dedicating all your day to monitor your charts, to search for trading opportunities, etc., etc. All right, okay, without any further delay, let's get started. Alright, well, I guess we should start the module by, defining the reasons as of why I believe that the best decision you can take in order to become a part-time trader is to move away from intraday trading. I know that intraday trading, the intraday charts are more glamorous, more sexy, so to speak. But again, I believe that intraday trading is really not for part-time traders, and there are quite a few specific reasons as of why I make this bold statement. Which is exactly what I'm gonna try to nail down on this video. First of all, there is no such a thing as sitting on your trading station, early in the morning to take a quick trade before breakfast, fish a quick 10-15 pips out of the market, and to be done for the day, so you can merrily walk away from your computer and go to your day job. All right, that's just not feasible. If anyone has led you to believe that, again, you can take a quick trade before breakfast in 20-30 minutes and that's about it, you are done for the day, I'm sorry, but that's just not logical thinking. All right, that's wishful thinking. The thing is that there is plenty of stuff going on from an intraday trading point of view. Okay, on an intraday basis, there is plenty of random market noise on the shorter time frames. Then you have the news announcements that are being released every day and actually multiple times throughout the day, and you're going to be experiencing plenty of market interruptions from an intraday point of view. All right, so it's not as easy as just firing off your charting platform, take a quick trade, and set your stop loss, set your profit taking levels, and that's it. You are done for the day. I'm sorry, but it's not that easy. Again, that's wishful thinking, and intraday trading takes a little bit more than that to make it work. That's precisely why I say that the best decision you can take is to move away from the intraday charts and to focus on to the daily time frame, all right, the weekly time frame, and even the monthly time frame. This may be a little bit too long-term chart for most of you, so we are going to be focusing mostly on the daily and the weekly charts. The thing is that they are easier to search for trades, and once you've actually find a profitable trading opportunity, it is much easier to manage that trade. All right. Now, why is it easier to search for trading opportunities as a part-time trader from the long-term charts? Well, by definition, the daily, the weekly time frames move slowly. All right. Trading opportunities, trading setups, they do take their time to fully develop, okay, to fully present themselves. So you have plenty of time to seize the opportunity, to gauge the validity of a setup, whereas intraday traders need to take decisions on the fly. All right, the last thing you want to do is to stress yourself. If you only have 20 or 30 minutes per day to dedicate to your Forex charts, the last thing you want to do is to stress yourself thinking or knowing that you need to take a decision right now because you just don't have that much time to monitor your forex charts. Okay, so since the trading opportunities on the daily or the weekly charts take their time to develop, okay, the timing factor is not as crucial as it is on intraday trading. All right, whenever you are searching for intraday trading setups, intraday trading opportunities, the timing factor is crucial. Either you nail down your entry point on the very minute the signal comes by, okay, your system, your particular trading system gives you the entry signal. Well, if you do not nail down the entry on that at that precise moment, chances are you're gonna miss the intraday trading opportunity altogether. Well, that doesn't happen if you trade off the daily or the weekly. Again, because they move slowly and you have plenty of time to take that trade. Okay. But not only that, once you are actually involved in a trade, it's going to be much easier to manage that trade. Please don't make the mistake of believing that a trader's job is done once he actually clicks on the buy or the sell button. Okay, basically once he jumps into a trade. Once you are actually involved in that position, you need to manage that position. All right, you need to follow the trade in order to know when to let the profits run, when to actually cut a trade short, or when to actually exit out the trade altogether in case, well, the trade begins to lose momentum or turns around against your best interest, etc., etc. Okay, again, you need to manage that trade. So if you just have 20 or 30 minutes per day and you want to be an intraday trader, well, chances are you are not going to be able to close that trade within 20 minutes, right? I mean, that's just not possible, okay? The trade is going to span for a little bit longer, 1 hour, 2 hours, 3 hours, whatever it might be. But at any rate, it's certainly going to be way more than just 20 minutes. On the other hand, if you trade off the daily or weekly time frames, you can come back to your trading platform once a day, take a quick look into that trade, okay, into that position, 15, 20, 30 minutes, way more than enough to decide whether you let it run, you cut it short, you move your stop loss, whatever decision you may take. Okay, but at any rate, it's certainly more time friendly. And now I'd like to dispel a myth that I keep on reading on the internet forums, on Forex blogs. There is just so much misinformation out there, it's just scary. But anyway, like I say, there is a popular myth believing that intraday trading is more profitable than trading off the daily and weekly time frames. That's absolutely incorrect. Okay, it's just not accurate at all. And let me prove you why. Let's assume an intraday trader obviously seeks to take trades every day, all right, on every single trading session. Now, for the sake of discussion, let's assume an intraday trader finds a profitable trade every single day of the week. Now, trust me if I say that that's way more difficult than it sounds. It's easier to be said than done. But again, for the sake of discussion, let's assume an intraday trader finds a profitable trading opportunity every single day of the week. Now, that would be 5 trades per day, all right? Assuming they are all profitable, the typical intraday trading trade, well, seeks to make, I don't know, let's say 30 pips, 40 pips on average. Okay, these are small positions. Okay, intraday trading is all about high frequency trading, shooting for small individual profits per individual position. All right, so 30 or 40 pips per trade. Let's round it up to 35. All right, 5 times 35, this is 175 pips, if I am not mistaken, 175 pips per week. Now, there are 4 weeks in the month. It's 20, 28, 30, 700 pips. All right, that's 700 pips in profit per month on average as an intraday trader. Now, A trader who bases his or her trading decisions off the daily and weekly time frame, well, you are looking to take, as an average, in my experience, 3 or 4 trades per month. Alright, 3 or 4 trades per month. I know it doesn't sound that much, or that many actually, but that's more or less what you are looking to, the number of trades you are looking to take as a long-term trader. Now, 3 or 4 trades per month, obviously you are not going to be shooting for 35 pips per trade. If the longer time frame you are basing your decisions off, the longer or the larger the profit potentials, right? So as an average, in my experience, you are shooting for around 200 to 250 pips per individual position. All right. Now you do the math. I mean, 3 or 4 trades per month, aiming for 200 to 250 pips each. You do the math. It's at least as profitable as intraday trading. At the end of the month, the bottom line is that you are gonna come out just as profitable with an equal number of pips, either if you trade a high number of trades, shooting for small profits per position, or if you take few trades, shooting for large potential profits per position. All right. At the end of the month, again, do we trade for the sake of trading, or do we trade for the sake of profits? Again, I know that intraday trading may sound more exciting, more entertaining, but hey, we are not trading We are not trading Forex to have fun. Okay, we are not trading Forex to entertain ourselves. We are trading Forex to make profits. And the truth is that at the end of the month, the profits are more or less about equal. All right. So that's one myth that I really wanted to dispel here. Another piece of information that I usually see discussed over and over of the internet forums is that, trading off the daily and the weekly charts carries a higher degree of risk, since the size of the stop losses are usually larger. Well, obviously that's totally incorrect, and over the following videos you will see why. But like I say, it's certainly not correct at all. In fact, quite the opposite. Intraday trading does carry indeed a higher degree of risk for multiple reasons. For starters, the quality of the signals that you get on the intraday charts is usually a lower quality than those you get from the long-term charts. There is just too much market random noise on the intraday charts. Price action reading is more difficult. Price is more volatile, right? And gauging the validity of a trading signal is more difficult on the 5 minutes, 15 minutes time frame than on the daily or the weekly. Moreover, we have the news announcements. As you probably know, the market is hit by multiple news announcements on a daily basis, and they can easily spike price. Okay, can easily spike price 50 pips. All right, within the minute, literally within the minute. Okay, those 50 pip price spikes are massive. They create huge impact on the intraday charts. All right, from an intraday point of view, for an intraday trader, a 50 pip random spike on your chart can easily make the difference between a winning trade and a losing trade, since 50 pips is usually enough to hit your stop loss this quick. However, 50 pips for a trader who bases his trading decisions off the daily and the weekly time frames, quite frankly, that's just a small wiggle on your chart. Okay, it's going to make no impact whatsoever on your trading routine. So whereas intraday traders need to really pay attention to news announcements, to us long-term traders, we really pay no attention. We shouldn't be concerned at all. Now, another important point, not only long-term trading or trading off the longer time frames is just as profitable, less risky than intraday trading, but also is more efficient. And I'm talking about spread costs here. as you probably know, the spread is the entry fee, the commission cost you need to pay every time you trigger a trade. All right. Well, let's go back. Let's go back into our previous hypothetical, hypothetical case in which a intraday trader took 5 trades per week, shooting for 175 pips in profits. The spread varies quite a lot depending on what currency pair you're trading, but on a standard currency pair, for example, I don't know, the sterling pound against the American dollar, you are looking to pay between 2 and 3 pips of a spread depending on your broker. Okay, so 5 trades time 3 pips equals 15 pips at the end of the week just on commission. All right, 15 pips to make 175 pips of profits. Now, a trader who bases his trading decisions off the daily and weekly time frame seeks to make between 200 and 250 pips per individual trade. Now, since he only needs one bullet, one shot to make those 200 pips to round it up, he's just going to take one trade, all right? Times 3 pips equals obviously 3 pips. Well, which one seems more efficient to you? 15 pips of commissions to make 175 or 3 pips to make 200? All right. Obviously, intraday trading is way less efficient as per the commission cost. There is no way around that. So that's another plus for moving on to the daily and weekly time frames as a part-time trader. But there is another bonus as far as efficiency goes, and it's actually more important than cutting down on your commission costs, and that's the how wide your range of options is going to be as far as the different currency pairs you can have access to. Let me try to explain what I mean here. There are some particular currency pairs, such as, I don't know, the euro against the New Zealand dollar, the the sterling pound against the Canadian dollar, the Australian dollar against the Canadian dollar, the euro against the Australian dollar, etc., etc. There are quite a few different currency pairs where the spread cost is a little bit higher than usual, and they can span from 7 pips to, well, up to 10. Even 12 pips, depending on what broker you are using, okay? But yeah, between 6, 7, 8, 10 pips, of spread cost. Well, as an intraday trader, if you shoot for 35 or 40 pips per individual position, do you think it's a good idea to pay 10 pips to, as an entry commission, all right? He has to shoot for 40 pips. That means that 25% of your trade goes entirely to pay for the commission cost. That's insane. That's very, very inefficient. So, as a result, intraday traders have a shorter range of options as far as what currency pairs they can trade. They cannot really pay 10 pips from an intraday point of view. It's just too expensive, too inefficient. So they need to narrow down the number of different currency pairs they can trade. Now, obviously, as a long-term trader who is making 200 pips on average per position, well, it is okay to pay 10 pips if you are shooting for 200. All right, 10 pips out of 200 is just 5%. Okay, only 5% of the trade. Okay, 5% of 200 is 10 pips. Anyway, so you can really pay 10 pips. You don't care about 10 pips if you are shooting to make, or you are aiming to make 200 out of that position as a whole. All right. So, as a result, what does that mean? Well, the consequence is that you are gonna broaden up. You're going to expand the number of currency pairs, the number of currency pairs you are going to be searching for trading opportunities on. All right, you are going to open yourself to a whole new bunch of currency pairs that you just didn't have access to I mean, you did have access to, but it was not efficient as an intraday trader. All right, you're gonna be trading stuff like, again, the euro against the New Zealand dollar, the sterling pound against the New Zealand dollar, the Australian dollar against the Swiss franc. You know, currency pairs that are usually not, they are not usually traded that much from an intraday point of view, but as a long-term trader, you will indeed be able to search for trading opportunities on those currency pairs. And again, as a result, you're going to be able to find more trading opportunities. Obviously, the more trading instruments you follow, you monitor, well, the more trading opportunities you're going to find. So, as you can see, there are so many reasons to move away from the intraday charts if you are to become a part-time trader. I mean, if you are to become a full-time trader, sure, go ahead and specialize on intraday trading. There is nothing wrong with that. But if you are looking to spend 20, 30, 45 minutes of your day, only 20, 30, 45 minutes of your day in front of your charts, moving away from intraday trading is the best decision you can take. Okay, trust me on this one, guys. I've seen plenty of part-time traders getting burned on the intraday charts, and you know, it's just not their battlefield. Their battlefield should be the long-term chart. So throughout the following videos, we are going to be focusing on strategies that specialize on the daily and weekly time frames, on occasion on the monthly, but especially on the daily and weekly time frames. Those time frames are going to be our bread and butter, okay, as part-time traders. And again, trust me, it's going to be a good decision for you, okay, as a part-time trader. And on top of that, it's going to cut down on your stress levels. All right, your trading experience is going to be much more pleasant. Okay, and all in all, as I was mentioning before, you are going to be just as profitable and you're going to be more efficient as a trader. All right, so it's a win-win situation. Hello there, welcome to this new video where we are going to be digging right into the core of the strategies we are going to be studying on this module. Okay, basically we are going to be checking out the magic formula. All right, the winning formula, right? The formula to success as far as part-time trading goes. And the formula is very simple, actually. It's just levels of support and resistance, long-term levels of support and resistance, and then price action around those levels of support and resistance. Okay, basically what we are going to be doing here is to wait for price to reach a key decision taking level in your chart. Okay, a key decision taking junction or crossroad in your charts, and then we are going to be reading rather closely price action around that level. Depending on how price reacts of that particular level, well, we are going to be trading always in the direction of the reaction, okay, of the market reaction, either to the upside or to the downside. Let me try to explain what I mean. Let's imagine price had been, I don't know, uptrending, okay, on the daily, weekly time frame, on any long-term chart, all right, and eventually it pulls a final swing high of that level. Let me actually clean that up. Okay, price has been uptrending there, topping out at that level, and from there the trend collapses and it comes back down. Okay, that's a major swing point on this chart, the point at where price failed to keep on pushing through. All right, the price at where the bulls failed to sustain the control on this market, and they gave way to the bears, right? So we would mark that level as a key support and resistance level, right? And then let's assume price comes back, I don't know, 5, 6, whatever, however many weeks later, comes to retest that level once again. Now the question is, the question the market as a whole, the market analysts, big traders for working for investment funds, for central banks, the question they are asking themselves here is, will price respect that level of resistance once again, or will price fail to break above once again, and as a consequence we are going to see another retracement back down. Basically what we want to gather here, what those big traders, what they want to gather here is whether price will be able to give us a breakout or instead it will give us a price reversal. Our job as long-term traders here is to read very closely price action around that level, all right, price action around that level, and then simply trade in the direction of the market reaction as per some specific parameters that we are going to be seeing very soon on a following video, right? I don't want to get into the actual trigger signals, the actual price patterns we are going to be triggering our trades on. On this particular video, I just want to show you guys the concept, okay, what we are going to be basing our work on. So, once we've been able to define a key level of support and resistance, as soon as price comes to retest that level once again, the question remains, are we going to get a breakout or are we going to see a bounce? Those are the only two possible scenarios here, alright? Price cannot stay there forever, right? It just cannot. Eventually, it will either move up or move down. And we are going to have to be ready in order to trade in that direction. In that particular direction, if we get a breakout, we are going to be searching for particular price formations in order to signal our long entry. If we get a bounce, alright, if price respects that level of resistance once again, if it fails to break above, alright, and instead we get a bounce, well, we are going to be searching for some specific price formations in order to ride another move down, just as we saw the first time around, alright? That's basically the idea here. So, to wrap it up real quickly, we are going to map our daily, our weekly, our monthly charts with those key levels of support and resistance. Then we are going to wait for price to retest those levels, and then we are simply going to follow price action very closely for the upcoming days, see whether price gives us again either a breakout or a bounce, and then we trade accordingly as per few specific price patterns that we are going to be seeing over the following videos. Okay, that's all there is here. All right, that's all there is. All there is here. I know it sounds simple. I know it sounds rather straightforward, but trust me guys, simple works. We don't need to overcomplicate things here, all right? We don't need to search for complex combination of indicators. None of that. We're just going to be basing our decisions straight from price action around key decision taking levels, and then we're going to take our trade and we're going to monitor that trade over the following days. And again, don't you worry, it's not going to take more than 20 minutes a day. Just a quick look into your charts to decide whether you want to let the trade run or, to exit the trade altogether, etc., etc. But at any rate, the formula we are going to be following, all those different strategies I'm going to show you very shortly are based on this principle. Key levels of support and resistance, price reaction of those levels, trade accordingly. As simple as that. Hello there, Hector Davil here. In the previous video, we specified the formula of success, so to speak. All right, which was basically trading price action around key levels of support and resistance. Okay, we had those two elements. All right, price action patterns, which we will see on future videos, around key levels of support and resistance. Well, on this particular video, we are going to be talking about how to map your charts. All right, basically how to draw those key levels of support and resistance. So, so we can define those areas we want to pay special attention to, all right? We want to focus our attention on once price reaches those key decision taking levels. All right. Okay, we are going to be following or marking 4 different types of levels of support and resistance in our charts. First of all, significant swing point. What's a swing point? Well, a swing point is a turning point in your chart. All right. So if price went up, then down, and then up again, we have these 2 major swing points in your chart. All right, levels, specific horizontal levels where price has either found heavy resistance or heavy support, and therefore is bouncing off those levels. We simply need to mark a horizontal line, so next time price comes to either hit one of them, well, we'll be searching for our favorite price patterns in order to determine the next course of action, okay, the next trading opportunity. Now, significant, okay, you want to mark only the most obvious or significant swing points. So if price has been zigzagging up and down, topping out at one particular level and then begins to zigzag down, well, you do not want to mark every single swing high and swing low, right? You don't want dozens of horizontal lines in your chart. You just want one or two. All right. In this case, that would be the major significant swing point in your chart. All right. That's the one to follow. Okay. The more lines you draw on your charts, the more confusing they are gonna get. All right. And at the end of the day, not every single turning point, okay, not every swing low is really significant. Just the major turning points. All right. Assuming price found support once again of that level and began to zigzag from that point on, well, you just mark that one. Okay. The key, the point where the former trend ended. All right. Where the former trend ended and gave way to a whole new one, all right, a whole new trend. So please don't mark again dozens of more horizontal lines in your chart, just the very most obvious ones. Now, I keep on saying that you need to mark only the most obvious swing points. Why do I use the word obvious? Well, the reason for that is because of the nature of support and resistance. Have you ever wondered why any particular level does actually work as support and resistance? What's the reasoning as of why one particular level may repel or attract price over and over? Let me give you the answer here. It's got nothing to do with any hidden mechanism running behind the Forex market. It's certainly not any type of magic or the market's fairy or it's none of that. It's just mass psychology. All right, mass psychology. Please mind that a market is nothing but a community of traders coming together. All right, a market is just nothing but ultimately is nothing but a bunch of people wanting to buy an asset, for example, the euro against the American dollar, and another bunch of people willing to sell that asset. And since they need to cross those transactions, they simply go into one specific place to arrange, okay, those dealings, and that's the Forex market. All right. But at the end of the day, what I'm trying to stress here is that the Forex market is driven by traders, and traders are people, all right, human beings just like you and me. And therefore, psychology also affects those traders. Now, let me give you an analogy. Have you noticed how the price for flying tickets, okay, plane tickets, go up quite significantly? So actually, around Christmas days or around summertime, Easter, some specific dates throughout the year where the price for those flight tickets almost double. Have you noticed that? Is that because, I don't know, the petrol for the planes, the price for the petrol for the planes go up throughout those days? Is that so? Or maybe because the pilots are paid 3 times as much throughout those days? Or is it because the airport fees, triple or quadruple throughout those days? No, not really, guys, not at all. The only reason as of why price of flight tickets go up in August, Christmas, etc., is because of the market behavior from a mass point of view, from a collective point of view. As more and more people are focusing their attention on getting flight tickets around, vacation on times, well, as a result, the prices go up just like that. Is the actual behavior, all right? The actual behavior patterns of the consumers that drives the prices of those items up. Well, in Forex it happens exactly the same. Actually, not only Forex. Again, the prices of champagne go up quite significantly so as well around Christmas days. Have you ever noticed that? And trust me, the champagne in itself is just the same on the 25th of December or on the 3rd of March. I mean, the item in itself is just the same. So why does it go up at those specific times? Again, it's just the behavior patterns of those people involved in such market, meaning people who buy and people who sell that specific item. Okay, well, in Forex markets happens exactly the same around those key levels of support and resistance. The price level in itself is totally insignificant. It doesn't matter. There is nothing special about that price level. The only reason as of why price reacts to that level is because everyone, okay, any single trader around the world has marked that specific level, has taken a quick note on their notepad, all right, on their charting platform, and and realizes that, well, that particular level is a level of support and resistance, and therefore next time price comes to test that level, they are gonna click on their buy or sell buttons around that area. All right, the only reason as of why price moves is because there is trading volume driving price in any specific direction, either up or down, depending on whether there are more buy orders or sell orders. That's as simple as that. So next time price comes to retest a previous level of resistance, in this case since price is below that level, well, a number of people are going to click on their buy or sell buttons, meaning trading volume is going to increase around that time, and therefore price is bound to react of that spike in that temporary spike in price volume. That's like saying, like, this particular level is Christmas time, and price is the price of champagne. Whenever champagne meets Christmas, price reacts. Okay, the price is bound to take some type of reaction. Well, this is exactly the same thing. All right. Now, why am I telling you all this mambo jumbo about market psychology and whatnot? Well, the reason for that is going back to the basics. You need to mark only significant and obvious swing points in your chart. Again, you only want to mark the obvious levels to make sure that all the traders around the world have marked that specific level as well on their respective charts. So you don't want to mark, let's imagine price was something like this, a little, minimal swing point there, a small swing point there, and well, you decide to mark both of them. Now, what are the chances that traders around the world have marked this level as a key level of support and resistance? Well, quite high, certainly quite high. So again, chances that whenever price comes to retest that level, price is bound to react off that level, correct? Well, now, what are the chances that those traders around the world have marked that one? Well, they are not so big, okay, not so large. There are, chances are that not really many traders are going to be actually monitoring price action around that level. So, whenever price comes back to hit that level once again, do you think trading volume around the world is going to increase just because plenty of traders are looking to trade around that specific level? Not really, not really. And as a consequence, you may be searching for price patterns around that area, and well, obviously, whatever trading signal you may get is going to be a low quality signal because there is not enough volume, okay, not enough trading volume driving price in the direction of that trading signal. Again, if there is no trading volume, if there are not enough traders pumping in their trading orders at that specific level, the quality of the signal, all right, the quality of the trading signal is going to just, it's just going to be a low quality one, all right? It's not going to be the win-loss ratio on those signals, on those low quality signals, is going to drop. And obviously that's not what you want for your trading, right? You want to keep your win-loss ratios rather high. So you need to make sure that the only signals you trade, the only market levels of support and resistance you follow, you mark, or you look forward trading in your chart are the most important ones, the most obvious ones. Again, because that's where the massive trading volume is going to be waiting. So if you get a buy order around that area and is backed up by massive trading volume, bang, price is going to move in your direction much more swiftly, right, and much more with a higher chance of profitability. Alright, enough of beating that horse, I reckon. So, obvious levels, that applies to both, to all swing points, trend lines, range boundaries, Fibonacci retracements, to all of them, okay? Only mark the most obvious ones. Now, moving on to the next one, trend lines. Trend lines, as you know, are, well, diagonal levels of support and resistance, and in this case, in order to draw a trend line, you need two swing points, all right? Two swing points that are obviously not lined up together. If you have two lined up together, what you have is a double top, and then you could mark, well, that obviously as a horizontal level of support and resistance. By the way, I forgot to mention that before. If you have two swing points, all right, instead of one, that's obviously a stronger level of resistance, because that's a level of resistance that's already been confirmed. If you have just one, you draw the line and then you wait for price to, well, hit that level once again. However, if you have already two, well, that level has already been confirmed as resistance with that second bounce of that particular level, and therefore, well, the strength of that particular level goes up, okay, increases, and the market awareness of that level certainly is it's much higher. So next time price comes to retest that level, the market reaction is going to be sharper, even sharper than if you just had one swing point of that level. Okay, so double tops, even triple tops are the best types of horizontal levels of support and resistance. Obviously, the same goes, the same thing is valid for double bottoms or even triple bottoms. All right. Those are the strongest levels of, levels of support and resistance based on swing points that you can find. Anyway, let's go back into trend lines. As I was mentioning before, you need at least two swing points in order to draw a trend line. If the trend line is under or below price, then it's an up pointing trend line. If price is the one below the trend line, then that means that we are on a downtrend. Okay, so the idea here is exactly the same thing. Just wait for price to hit the trend line once again. All right, and then, well, wait or try to see if you can spot the price patterns that we're going to be talking in a future video, in order to search for bounce trades, all right, continuation trades, basically trades in the direction of the trade, or breakout trades. Okay, now this time around, if you have a second swing point bouncing off that trend line, all right, this being the first one, then you can indeed draw the trend line. Well, if you confirm, or if price confirms that trend line with a consequent bounce later on, all right, and therefore you would have that trend line linking three swing points altogether, well, that is a much stronger trend line. The more touches, the more times a trend line or a horizontal level of support and resistance is being confirmed, the stronger it gets. Okay, that's a universal market principle. Now, one quick note about trend lines. You need to draw the trend line from the very beginning of the trend, meaning that this is the swing point that you would mark with a horizontal line. If price had been zigzagging down, this is the end of the former downtrend, and from here price turns around and begins to zigzag up. That's where you want to draw your trend lines from. All right, the very beginning of that trend. All right, this uptrend in this case, the very beginning, or actually the very end of the previous move. All right, this is the focal point, the swing point, the turning point, and that's where your trend lines should be, should start from, and from there you would link the trend lines with consequent swing points within that uptrend. Now, and final note about trend lines, and this is important, guys. We are only going to mark, I repeat, only going to mark the outer trend line of a trend. All right. In any trend, you can draw plenty of trends, right? Plenty of them. Plenty of trend lines. Let's say there are multiple trend lines within every trend. Okay, within one single trend. For example, we have this zigzag here. All right. This is the outer trend line, as we can see. Then we probably have price swinging something like that. Well, we could draw another trend line there, an inner trend line, and also an inner trend line in there. All right, I hope you get the point. Well, we are not going to be interested in inner trend lines. We just want to we just want to mark the last line of defense, okay? The line linking the two outer swings. So, if price later on comes back down, breaches that trend line, and from there makes a new high, and therefore the trend as a whole has been resumed, you need to readjust this trend line, all right, and to move it down there. All right, you would simply move that trend line and position it like that. So, whoops, sorry about that. Let's see if I can actually we would move that. Let me keep on drawing this little case example on my screen. This won't take more than a minute. Just give me a second. All right, so if this was our previous trend line there, all right, once price actually breaks that trend line and marks a swing low, as soon as price hits or takes out the previous swing high, we can certainly mark that level we can certainly assume that the trend keeps on pushing, since price keeps on making new highs at least higher highs than the previous swing high. Well, at that moment on, whenever price has actually made a new swing high, well, we simply move down this trend line and mark the new outer trend line. All right, we are only now going to be interested in price formations once price comes to retest that trend line again, in price formations around this trend line. Okay, either again we're going to search for either bounces or breakouts, but at any rate, this is the new level to keep an eye on now from this moment on. Alright, well, moving on with the presentation, ranges, range boundaries. A range is basically nothing but a price congestion, okay? Whenever price is not really trending either up or down, but simply flapping sideways, okay, moving sideways without any type of trending pattern, well, you can usually define, okay, more often than not, the boundaries of that range, okay, the limits where price is entrapped within. Okay, well, those are another elements of levels of support and resistance that we are going to mark in our chart. Okay, now the ranges can take the shape of either horizontal ranges or triangles. Okay, where price is simply compressing towards the vortex of that triangle. Both of them are equally right. I myself prefer to see horizontal ranges. Okay, I am not quite fond of trading triangles. Don't you worry, we are gonna get into that in detail in a future video. But just to just for you to know that I myself usually score better or sustain better win-loss ratios whenever I am trading price formations around the range boundaries of diagonal ranges. All right, I don't quite get that. I've never been able to sustain that high win-loss ratio in my trading whenever the range actually takes shape of a triangle. Okay, so at the beginning you may want to simply stick with horizontal ranges. Also, you can have what's usually called expanding ranges, which is actually something like this. Alright, price is not really trending either up or down, it's simply flapping sideways in an expanding fashion. Alright, this is absolutely crazy. Okay, this is market confusion at its best. Every consecutive swing price takes, it carries a higher degree of momentum than the previous one, but it always reverses around and it keeps on moving at the end of the day sideways, building up momentum on and on and on and on with wider and wider and wider waves or swings. Okay, this is this is usually regarded in among traders as market confusion, as market chaotic movements, and my recommendation is to not trade them at all. Okay, I personally don't trade that type of formation at all. That's just out of whack. I've never been able to make consistent money out of this type of expanding ranges. All right, so at the beginning, I would recommend you to stick to sideways ranges. Okay. All right, and finally, moving on to the the fourth type of level of support and resistance, we're going to mark in our chart Fibonacci retracements. Now, I'm not gonna explain what the Fibonacci series or the Fibonacci retracements, which is the application of the Fibonacci series into the Forex world. If you've never heard about this funny word Fibonacci before, I'm afraid that that's way beyond the scope of this presentation. I mean, you could spend I don't know, hundreds of hours reading about Fibonacci. I've actually read the book about Fibonacci. I'm not going to get into, like I said, into what Fibonacci or who Fibonacci was. His name was Leonardo Pisano. He was a Italian mathematician in the 12th century. But anyway, like I said, I'm not going to get into that. You can find under this video an interesting link, that will take you to an article where you will, you'll be able to learn the basics of Fibonacci retracements. All right. But like I say, I am just going to refer to the actual uses or to the actual applications we are going to do of Fibonacci and the Fibonacci retracements as far as part-time trading. Okay, as far as finding levels of support and resistance around Fibonacci retracements. Okay. Now, there are multiple levels of Fibonacci retracements. I personally only pay attention to the 38%, the 50 and the 61. There is also the 23 there and the 76% there, but I don't really pay attention to those. My favorite ones are 38, 50 and 61. Also, I don't actually search for the actual levels, okay, right to the pip. To me, Fibonacci retracements is more of an area rather than a level, than few levels in themselves. Okay, so I'm going to be interested in this area here between the 38 and the 61. Any type, right? If we are in a trending scenario, any type of retracement that falls between the 38 and the 61 area, well, any type of market of price pattern, of reversal price pattern, okay, that may signal or that may clue us into the beginning of a whole new swing in the direction of the trend, well, any signal that happens in between the 38 and the 61% area is going to be valid as far as I am concerned. Again, it doesn't have to happen right off the peep, all right, right off to the peep of any of those particular Fibonacci retracements. I mean, if it happens, the better. All right, but still, it's not a necessary requirement. Okay. Now, I like to also go back into the basic here. Only mark the most obvious Fibonacci retracements. Okay, please mind that Fibonacci retracements are only valid on trending scenarios. You need to have swings moving in one single direction. Retracements mark by their nature potential retracing points. Okay, potential retracing points of that swing. Okay, if we have a market push in one direction, well, the Fibonacci retracements mark the potential levels where the retracement is going to go in a trending scenario. If there is no clear trend, if there is no clear swing in the direction of the trend, you cannot draw any significant Fibonacci retracement. Again, you only want to mark those retracements that are obvious, or rather, you want to draw the retracements of obvious swings in obvious trends. If it's not obvious, always ask yourself, what are the chances that all the traders around the world are gonna mark the same Fibonacci retracements, the same trend line, the same swing points on their respective charts? If you can honestly say, yes, this is an obvious level of support and resistance, and I assume most of the traders are going to also agree with me and are going to mark this particular level on their respective charts, then go ahead and mark those levels and wait for price patterns around those levels. Okay, so to wrap it up, you need clear swings, all right, in clear trending scenarios. That's all you need. Once you have that final swing, mark the low or the beginning of that swing to the end, and you get then the potential Fibonacci retracements. We are gonna be looking or waiting or spotting, monitoring price action in order to find or to trade potential reversal price patterns. Okay. All right, now we're going to run a few exercises just to make sure we are all on the same page. Obviously, at the beginning, recognizing significant levels of support and resistance, well, let's say it does take its time. Okay, at the beginning it might be a little bit difficult, so that's why we're going to run a few exercises here, just some random charts, just to make sure we are all on the same page. All right, well, Euro against the Australian dollar, monthly time frame. Please mind that we are only going to be drawing these key levels of support and resistance on the daily, weekly, and monthly time frame. Now, take a mental note of this chart. All right, pause the video if you wish. Draw the key levels of support and resistance that you see here. Just pause the video and do that little exercise for me, please. Okay, have you done it? If not, go ahead, don't skip the exercise, pause the video and please draw the levels. Alright, I'm gonna do my thing here. Alright, first of all, levels of horizontal support and resistance, basically key swing points. Do we have any key horizontal level of support and resistance here? Yes, we do. We actually have two. This one is the most important one. Again, because it's been retested once, twice, and in fact, now price, if you notice, is actually, let me draw an actual horizontal line there. Alright, that's it. Once there, actually multiple times there, and there, and now price has just hit that level. Now it would be a fantastic idea to begin searching for trading opportunities at that precise junction of the chart. As you can see, price is hitting a key level of support, all right? Actually, a level of support that's been retested twice before, all right? And now a third time. This will be a fantastic junction in the chart to search for either bounces or breakouts, as per the patterns you will see very soon. Alright, but I don't want to get ahead of myself. We are just now recognizing levels of support and resistance on this particular video, so that would be one. Any other? Do you see any other key level of support? Any other turning point? Key turning point? Yes, we do. We have that one there. Alright, that one there. Now you don't want to go back in time, all right, and draw this one there and this one there. Those are too old, and in fact, as you can see, they are already broken. Okay, price already broke free. All right, so for the time being, we only have these two here. All right, we used to have a range here. Do you see this range? All right, price simply flapping, swinging up and down. All right, within these two boundaries, but that range already gave way. Okay, it already gave way. Price already broke free from that range, so it's not applicable anymore. Okay, now any trend line, no, we cannot really draw any trend line here. I mean, remember that in order to draw a trend line, you need two swing points. Okay, two swing points to link them up together in a straight line, all right, basically forming the trend line. Here we just have one full swing to the downside. We have one swing point, all right, the beginning of the trend, but do we have another swing point? No, we don't really have that swing point, okay, so we cannot draw any trend line whatsoever here. Now, any Fibonacci retracement? Well, Fibonacci retracements are only meant to be drawn or marked off the last swing. This is the last swing here. It is a clear swing in one given direction. All right, so we can certainly mark the Fibonacci retracement from the beginning of the swing to the end, and this is the area. All right, if price is to, let's assume it finds support here, we find a trading opportunity, we ride it all the way back up to this Fibonacci retracement from the 32 to the 61% Fibonacci retracement. All right, well, that's where we would like to search for reversal trading opportunities for another move down. All right, now we are not really in a trending market scenario. Okay, we just have one swing. One swing is not a trend. A trend by definition needs at least two swings. All right, one swing is just that. It's just one swing. That's not a trend. All right, so a trend a trend requires two swings. Now, since we don't really have any trending scenario here, we just have one swing, well, this Fibonacci retracement area is not going to be that strong because we are not on a trending scenario. That means that, yes, sure, we may find some reversal price formations of that area, and if we find them, we could trade them, but they are not going to carry as high of a quality as a trading signal as if price was already going through the second. All right, if price was already going through the second swing. All right, that's not the case here. The second, the third, the fourth, the more the merrier, obviously. In this case, we are trading the retracement of the first swing, and you should be careful there, okay? That's going to carry probably a higher degree of risk. All right, but anyway, those are the only levels of key support and resistance here in this chart. Let me clean up the chart altogether. Here we are. First of all, this one there, which, as you can see, we can already begin searching for trading opportunities there. That one there, and then the Fibonacci area somewhere in between that area. All right. Here we want to search for either a bounce, or if price breaks through, for a breakout type of price pattern. Here we would be interested only in reversal formations, okay, on bounce formations. If we don't get the bounce, we will need to wait here in order to, well, search for, again, either a bounce formation or a breakout formation. All right. Okay, next example, the sterling pound against the Canadian dollar, weekly time frame. What levels of key support and resistance do you see here, guys? Please pause the video. I'll give you a few minutes if you want. All right, and just take mental notes of the levels that you see here. Okay, I'm gonna do my thing now. Well, there is an area of support around this area. All right, do you see how these three levels have been bottoming out at that precise area? All right, as around the same level. Now, this is not quite a level of support and resistance, because we cannot really just draw one line, one particular line. All right, where all these three lows, these three turning points, line up in one single line. We cannot do that, right? Can we? So this is more of an area. Around this area there are plenty of buying pressure, so every time price hits this area, price has bounced to the upside. Alright, so you need to take into consideration that the markets are not perfect. Okay, the markets are not perfect. You cannot always expect price to react right to the peak of one particular level. Or sometimes it's not about levels of support and resistance, it's about areas of support and resistance. But at any rate, this area here is an area that you would want to mark. All right, you have two levels here, that one and that one there. All right, that's a level of support that you want to mark in your chart. So let's do just that. Whoop, there we are. Now, can we draw any trend line, for example? Yes, we do. Beginning of the trend, all right? Swing point, we have two swing points there, so we can already draw a trend line. There we are. We also have another swing point there, a major swing point there. Okay, another swing point there. This one is not quite as obvious. But still, you know, there it should, it goes there. And obviously, the beginning of the trend. However, please mind how price is this current market price, how price is way far off from this one and this one. So you don't want to cloud your thinking with too many lines. You're better off just deleting these lines, all right? And whenever price comes in the near abouts, well, you will mark it. You know that you have resistance around that area with that double resistance, all right? Obviously, you have two or more different levels of support and resistance coming together at the same level, all right? At the same level, we have a swing high there, all right? And the trend line coming around the same area, that's obviously double resistance, okay? And therefore, any signal, any reversal signal you may get of this area is going to carry an extra degree of strength, all right? Now, let me continue with the presentation now, with the exercise. We also have that level there. If price is to come back down here, we can again search for bounces or breakouts. If price goes up here, either we get a bounce or a breakout. If we get a breakout, we would need then indeed draw this next level of resistance, all right? And well, take our buy entry if we get a breakout pattern, a breakout, a signal, trading signal, and we would ride it all the way up there. At that level, what do? Again, search for either bounces or breakouts. Do we get a bounce? What's the next level? Oops, sorry about that. If we get a breakout here, and here we get the bounce, well, we would zoom or we would aim for this now level, all right? For this level, former resistance. Now, if it is broken, it may work as support. You may have heard that concept before, okay, of former resistance once broken may work as support, or former support once broken may work as resistance. All right, so we would, if we get a bounce here, a bounce pattern here, we would shoot for this area. If we get a breakout, obviously the next level of resistance is up there. All right, and again, we would do exactly the same thing. Do we get the bounce? Do we get the breakout? And then we trade accordingly. All right. But at any rate, these are the lines you should have marked on your chart. This one here, well, as you can see, this one was already broken once, was already broken twice. It's not significant anymore. It's been broken way too many times. All right. This one is the one to keep an eye on. This one and this area there with that double resistance there. All right, next one up, Australian dollar against American dollar, daily time frame. Take your while, all right, pause the video, do your thing. And now I am going to do my thing myself. Levels of support and resistance, trend lines, whatever. What do we have in this chart? Well, in this chart, I can see with a quick look this area All right, that particular level working as resistance, well, for quite a while, okay, quite a number of times. We did have a little bit of a breakout there, but it was a fake breakout. Do you see how price failed to keep on pushing and eventually it came back down? All right, that's what we call on the Forex lingo a fake breakout. And don't you worry, we'll see all about that on a future video. You will learn how to trade that. So, level of resistance, fake breakout meaning resistance. A fake breakout, I mean a breakout, if it doesn't pull through, means that the resistance is still there. All right, it's still there. It's not being effectively being broken. All right, another resistance there, another resistance there, and another resistance there. So this is a heavy level of resistance. Next time price comes back to hit this level, we can either we can expect big momentum out of the consequent move, no matter whether if it's a bounce or a breakout. Like I say, the consequent move is going to happen in momentum, and we are going to have we could potentially get nice trading opportunities there. It's just a matter of waiting for price to hit that level once again. But at any rate, our job is to mark it in our chart. Another level, well, we have this one and that one there. You see that? You see how price bottomed out at that level twice, all right, forming support below price and resistance above. This was some sort of a channel, okay, of a range, but then it got broken, and then it got broken to the upside once again. All right, you can indeed extend levels of horizontal levels of support and resistance, but anyway, broken, now broken. Every time a particular level is broken, it loses its strength, because more and more, please remember, mass psychology here, more and more traders are going to be inclined to simply take out this line from the charts altogether. Okay, at the beginning they all had it marked. If I can actually do it, all right, they all had it marked there. All right, then it got broken, then it got broken again. All right, they will just think, all right, this is not valid anymore, I simply cancel it. Okay, so the more times a line is broken, right, or a particular level of support and resistance is broken, the less efficient it becomes. My rule of the thumb, well, if it's broken twice in a row, I might as well just cancel it. All right, I will not take off that line on the first breakout, because again, we may see the typical former support once retested becomes resistance, so we may get a bounce off that level. All right, but if it's broken once again, that means twice in a row, I usually just simply take it off. All right, now obviously we have this nice swing point there. All right, so I would also mark this level there. And well, we could mark the can we mark any trend line here? Not really. We don't have. First of all, we don't have a trend, right? This is not a trend in a scenario, and also we don't really have any two consecutive swing points in one given direction, so we could link. This is obviously not a trend. All right, sorry. This is not a trend, since price still has not given us any bounce, and therefore we cannot really link two different swing points. Okay, basically there is no second swing point there. All right, we have one, but we don't have the second one there, so no trend line here. Any Fibonacci retracement? Well, yeah, I guess we could draw this Fibonacci retracement from there to there. All right, from the beginning of the swing to the end of the swing, and then we have the 38, the 50, and the 61 somewhere in there. But again, this is not a trend in a scenario. If you don't have a trend in a scenario, Fibonacci's become quite weak. In my experience, Fibonacci retracements are only as strong in trending scenarios. Whenever you are not in any trending market condition, they really become weaker. Okay, so be careful with the Fibonacci retracements on non-trending scenarios, guys. And that's about it. That's about it. Only these two levels to keep an eye on. Our job as a trader now, wait for price to come back down here, and again, either breakout or either bounce or breakout and trade accordingly, or come up here and either a bounce or a breakout and trade accordingly. As simple as that. This would be, as far as the Australian dollar against the American dollar daily time frame, this would be the two levels that we would be looking to trade. Only those two levels. As long as price is anywhere in between, we are just not going to we are just not going to mind the Australian dollar against the American dollar at all. That's why, do you see now why these strategies can be traded in only 20 minutes a day? Because unless price comes back down here, we're just not even going to look at the Australian dollar against the American dollar. There are plenty of different techniques to be notified whenever price hits those levels, such as sound alarms, email alarms, etc., etc. But in the meantime, we are not going to waste one single minute of our day looking or staring at this particular currency pair. Okay, New Zealand dollar against the Australian dollar, daily time frame. Pause the video if you so want. If not, I am going to do my thing now. Alright, as usual, we start off with horizontal levels of support and resistance. Well, let me scroll back a little bit. Alright, well, few swing points to the downside, this one, and this one. Okay, we somewhat have some sort of a down channel here. Do you see that down channel there? So, alright, yeah, I would simply mark this one down there, this one down there, and well, those are the two levels of support and resistance that I clearly see here. Then obviously, well, this is the latest swing point to the downside, so we would also mark that with a horizontal line, and this is the latest swing point to the upside, so we would also mark that with a horizontal line. All right, let me mark that level up there and this level. All right, this one and this one. Other than that, I don't know. I don't really see anything. I don't really see much here. We have an inner trend line here. You guys see that inner trend line? But again, we have now an outer trend line there. All right. Again, being a channel, okay, a range. And that's about it. Nothing special here, right? So we would wait for price to come back down there, see if we can get any type of reaction. If we get a breakout of that level, well, we would be aiming, we would be shooting for the continuation of this channel boundary to the low of that channel down there. Okay, if we get a breakout, we would shoot for this area. Up here, well, we have double resistance, all right? The channel top and this swing point somewhere in there. Okay, so if price comes back, this is the area where we would be searching for either bounces or breakouts. Next one up, American dollar against the Canadian dollar, weekly time frame. What do we see here? Well, this is a rather ugly chart, quite frankly. We have obviously a key level of support, of resistance in there with multiple touches to the upside. All right, so we would certainly want to mark that horizontal line around that area. All right, we also have a double bottom there. All right, double bottom there. Do you see that's how price found support of that area twice? So there it goes. And whoops, just let me be accurate. You want to be accurate with your levels, guys. Don't be sloppy with your trend lines or horizontal levels of support and resistance, etc., etc. Now, any trend line, well, highest point of the trend, swing point, that trend line is broken. The trend line, actually, no matter what trend line, I mean, if I pick these two swing points there, we can see how the trend line is broken. Okay, once a particular trend line is broken, it really becomes weak. All right, so please be very, very cautious with broken trend lines. Then I don't really see any other swing point, any other clear swing point. Do you see, guys, now what I was mentioning before? Obvious swing points. The only obvious swing points here is this one and this one. We have another one there, but that's rather ugly. It's a small one. Then we have another one there. And are they obvious? I mean, I need to ask myself, what are the chances that some of the traders will be drawing, I don't know, some obscure trend lines in the charts, such as these ones? Not really. I very much doubt anyone is going to have those, at least, as a collective, the market Is the market going to have, most of the traders, the majority of the traders, are going to have those trend lines there? Chances are they won't, all right? And if the market doesn't draw those trend lines, I don't want to draw those trend lines, all right? So as far as trend lines is concerned, this is the only one that I would mark. It's already broken, so I cancel it. So we also have some sort of support around that area, former support, then working as resistance, but again, it's a little bit obscure. A little bit obscure. You know, this is what I'm talking about here, right? Support in there, then a little bit of resistance in there, but it's not really that obvious, is it? So, you know, price breaking and then breaking once again. Same as in here, you know. Breaking, then it works somewhat as resistance there, but not so obvious, guys, not so obvious. Do not draw those obscure levels, just the most obvious ones. If they are not obvious, you don't want to, you don't want to do any business with them. So, well, as far as I am concerned, I don't really see anything but these lines there. Actually, this one is an obvious turning point there. Okay, maybe not the most significant one, since it's the midpoint within a trend. It's the mid turning point within one established trend. It's not the extremes of the trend. The extremes of the trends are obviously the most important ones. This one is somewhere in between the trend, but still, you know, worth taking a note of. And this is just as much as I would track on this particular chart. Right? So we've already gotten the bounce here, so you know, obviously, you know, we are too late for this trading opportunity there. But at any rate, these are the three lines that I would mark on this particular chart. Okay, another one. American dollar against the Japanese yen weekly time frame. Let me scroll back a little. Oops, actually, let me zoom out just to have a clear picture to fit everything on the screen. All right, there it is. What do we have here? Well, as usual, we start off with the key levels of support and resistance. We had a former level of support there and support there once again, right? Double support, and it got a little bit broken there. Every time it gets broken, a level of support weakens out a little bit. But at any rate, price came back up, didn't it? So it's still worth taking that note. As if price has come back above that level of support, we should still keep that level in place. Now we have another level of support in there, of course, all right, with the final swing point. What else? We have this one here, but then that one got broken and broken once again and then broken. Okay, so that one is a no-go. I'm just gonna mark the ones that I'm gonna keep on my chart. That one there, and this one here. Now, out of the two, this one is of course way more important. Okay, this is the final swing on this trend. So if you really want to simplify things, this one you can take it out. All right, if you want to simplify things, the reference point, the reference support point in this trend right now is this one. Okay, this one is a milder level of support. Next levels of resistance. Obviously, we have the final swing high, then we have another one here, and another one here, and another one here at the beginning of the trend. Okay, this one being significant because it's the beginning of the trend, this one significant because it's the end of the trend, this one being significant as well because it's the last level of resistance, and these two, for the time being, well, we'll have to wait. For the time being, they are not that important to us, since price now it's still contained within this one and this one. In order to reach these two, first we need to deal with, you know, either of this one. Okay, so for the time being, I would simply mark these two. All right, should this one get broken, then I will draw this one up there. For the time being, it's not the case. Any trend line? Well, this is a textbook trend line. All right, textbook trend line there. All right, linking the beginning of the trend. You see how we have another swing point there and swing point there. This was the former trend line within this trend, but eventually it got broken. However, price came back down and scored a new low there. As soon as price ticks just one pip below the previous low, means that the trend is still in place. The down force, all right, the down pressure in this market is still strong, and now we just need to adjust our trend line. This is not the valid trend line anymore, this one there. Now the trend line, the how would I say, the trend line of reference, so to speak, the outer trend line, the last line of defense in this trend is this one there, right? That one there. That's the one that we want to keep in mind. And well, and that's about it. Now, obviously, we have some Fibonacci retracements. Okay, this is one swing, this is another swing, and this is another swing. Obviously, there are small swings within the swing, within the major swing. All right. Do you see how we have this little swing here, this little swing there? Don't get confused by micromanaging your trades. Okay, you're micromanaging your setups. Always look at the bigger picture. Also, we have micro swings there. You see those micro swings? Price, by its nature, zigzags up and down. Just try to look at the most complete pattern, all right? The pattern as a whole. That's one swing, that's another swing, that's another swing. So we could have drawn some, we could have marked some Fibonacci retracements there. But the bounce has already happened. As you can see, price fell between the 50 and the 61%, at any rate between the 38 and the 61%. So this, any type of signal we would have gotten around that bounce point would have indeed been a valid one. Okay, any reversal point. Now we can take off the Fibonacci retracement since the bounce has already happened. All right, let me mark the trend line. Sorry, I forgot to do that. Okay, nice bounce of the trend line in there. All right, and now let me zoom in a little bit more. All right, this is the current outlook we would keep on this particular trend. Sorry, on this particular chart. We had a previous level of support there, got broken, worked as resistance. But then it got broken once again to the upside, then broken to the downside. So I will not draw this line anymore. All right, I will just not draw it anymore. This one, and the trend line in itself. That's all for the time being. All I care about. So either price goes up and we get bounce or breakout, goes down and we get either a bounce or a breakout. For the time being, as long as price is away from these areas, all right, we should not spend a single minute on the euro against, on the American dollar against the Japanese yen. Okay? And well, and that's about it as far as mapping the charts with key levels of support and resistance. At the beginning, trust me if I say it may take a little bit of time, for you to get the hang of it. But don't you worry, as you gain practice, as you gain experience, marking out those levels of support and resistance is going to become some sort of a sixth sense to you. You'll be able to spot those key levels right away within the first second of staring at a Forex chart. All right. As a general rule of the thumb, my only recommendation, again, keep your charts clean. Do not draw more than 2 or 3 key levels. All right. Don't mark more than 2 or 3 levels, and always ask yourself how obvious that particular level is. If it's not, take it away. If one particular level has been broken twice in a row, take it away. Keep them clean, all right, with the most significant and current levels of support and resistance, all right. And you'll do great. That's all you need to do in order to map your charts.